Hello and welcome to the 2022 Quarter 1 review. So what a quarter. I mean, this has been the worst quarter for stocks since 2020, since COVID. And that has been spurred on by a whole host of issues we talked about previously when we talked about inflation, rising interest rates, things like that. So we'll touch on it very briefly. But the major impact has been what's happened with Ukraine and Russia. That's been the biggest story by far for the markets and especially for commodity prices in the world. Canada is actually seen as a net benefiter of that. And you see that in the stock market. So on the screen, hopefully you'll see the returns for the last quarter. When you look at the S&P 500, you'll see that's down 5%. But the TSX is actually up. So it's up just over 3%, which in a quarter where everything down is kind of impressive. And a lot of that is to do with where a lot of the returns are coming from and the parts of the stock market that are kind of getting beaten up. So the areas that have done really well are them high quality value stocks, them stocks that nobody wants to talk about because they're kind of boring. But the good thing is that they earn money. Falling into that category is infrastructure. For those that are familiar with my portfolios, there's an infrastructure piece that I've put in there for a very, very long time as a defensive stock position. And you always get the same question, especially in the past 3 or 4 years when it's underperformed technology, for instance, as to why you'd still have it. And these type of scenarios is why very high quality companies that have very strong balance sheets and a lot of cash flow do very well in these time periods. They might not grow like Google does during the very bullish markets, but during down markets, they hold up very well. We've seen a similar theme when you look at the energy heavy Canadian index versus the technology heavy US index. And that's a large reason why Canada is up on the quarter versus almost the rest of the world being down in some way or another. Another part is that with bonds down, we spoke about this previously and everybody saw this a mile away. With them hiking interest rates and more to come, that negatively impacts bond prices. But I did want to show you, I always like to bring into the number side of things. So when we look at previous rate hikes, so you see 4 here, so 1994, 1999, 2004, and 2015, previous rate hikes from the Fed. And on the right-hand corner, you'll see the total bond return for that period. The theme is we've been through rate hikes before. This won't be the last that we go through. And especially with their focus on curbing inflation, and they're not so worried about slowing down growth, it's very likely all the analysts are expecting us to see further increases, which does mean we will see some drag on bonds. But you also have to remember that this also includes the managers are still buying bonds that are currently coming available. So they're taking advantage of these higher interest rates. So over a period of time, it all evens out. So the drop in bond prices, not really concerned with. It is what it is. I wouldn't be too worried about it. And as always, if we're relying on this money, we have cash for these type of scenarios anyway, so not something to be too concerned over. So going back to inflation, the Bank of Canada monetary policy is shown a clear direction that they're more focused on getting inflation under control than they are trying to avoid recession. Recessions are part of an economic cycle and nothing really to be that afraid of. It doesn't mean just because you hear the word of recession doesn't mean it's going to be something like the Great Depression. It will very likely be a lot milder than that. But it is something that kind of expecting at this point. And it was almost inevitable because we knew that they were going to have to start drastically increasing rates in order to curb the increased money supply that they had to take on during all the stimulus they had to take on during COVID to get through that period of time. The expectation is for rates to hit about 2% for the overnight bank rate, which implies quite a few more rates this year, maybe even going on into next year. So the question isn't, the question is really how close do we, if we don't have a recession, how close do we come to a recession? And if we do have a recession, how far into a recession do we go? Obviously, in an ideal world, it's all timed perfectly and we have a very nice soft landing into a recession if there is one. What we don't want to see is the monetary policy get tightened too much and then suddenly we're back down to 0.5% interest rates because it was overdone, and we want to try to find some normality instead of yo-yoing with rate hikes up and down. So that's kind of what we're expecting. The real question is, how does that change the investment approach? And it doesn't really. So that's part of the reason that we have a very well diversified portfolio, is that there are always going to be parts of your portfolio that aren't performing as well as others. If you hold a portfolio, you could have had some Canadian stocks in there, which have done not very well, but have done a positive for the first quarter. And then you're also going to have some US, likely large technology companies that haven't done so well, but did extremely well for the past 2 years after COVID. So you're always going to have a variety of different assets. Some will do well in some environments, others will do well in other environments. So now for my opinion, I guess, what I think, what I'm hoping to see out of the rest of the year. And really I'm just looking for a stabilization. I'm not expecting this year, especially after the last few years, to be a 20% year in the stock market by any means. But I would like to see it flat, and my standard of flat is, within 2 or 3% points either way. That's kind of what I would like to see. We'll wait and see if we get something like that. But really, we ran really hot over the past year. The growth was very high. And because of that, it means that a lot of companies, especially the bigger companies, are actually in a really good position to weather any recession, to weather any increase in interest rates. The balance sheets on these companies are looking gigantic, especially coming off such a rough time with COVID. So I don't think there's really much risk of larger companies suddenly declaring bankruptcy like you sometimes have during recessions, because they have very strong balance sheets. I think a lot of it, because we ran so hot, is to do with that. It's kind of, we'd need to take a cooling off period, and that's not a bad thing at all, especially while we get inflation fixed. And as always, the story with how to fight inflation hasn't changed. When we had high inflation, we had bonds that we could run to because they offered much higher interest rates than they do now. We don't have that. Cash is almost the worst place to be because you're guaranteeing yourself almost negative 7% returns. So really the place to be is just to stay the course of what you have. And honestly, large stocks is still going to be a very safe and very good place to be. And there's also a reminder, I guess, to make sure you're focused on, if you're going to look into the companies and look at your investment portfolios closer, to remember that the companies aren't necessarily the same as the stock price. You hope that over time they reflect one another, but that's not always the case, and especially in the short term. The companies haven't fundamentally changed between now and a year ago when they were meeting all-time highs. Just the environment has changed. So that's an important thing to keep in mind when we do see declines like this. But as always, this won't be the first one. This isn't the first, won't be the last. We'll have worse quarters, I'm sure. But this has been the worst quarter in recent memory. So that might make it a little harder to swallow, but that's how it's going. So yeah, there's nothing to be too worried about. We'll kind of keep the course. And if you do have any questions or anything like that, please, as always, feel free to reach out to me. Thanks.